Okay, welcome to another run through of the top 5 charts of the week. This is the free weekly email that goes out to subscribers of the website. But first, here's I've got this little statement. Are you reviewing your research budget for 2019? If so, please get in touch. We've got a pretty interesting service here. Just email me, callum.thomas@topdowncharts.com. I'll forward through the latest report and pitch book for your review. We can go from there. Basically, it's very chart-focused reports, mix of investment ideas, macro views, risk management insights, and TAA, DAA positioning guide. It's aimed at portfolio managers, asset allocators, those looking for top-down input in their investment process. Anyway, that's that little pitch out of the road. We'll get straight into it. The first one here is the return of volatility. And this chart here is kind of a different one. It's the red line here is a 12-month rolling count of daily percent changes in the S&P 500, which exceeded plus or minus 1%, so moves greater than 1%, either way. And you can see there that after making a 50-year low, about the turn of the year, volatility is back. And, one of the interesting things about this chart is that when it comes back, it tends to sort of stick around for a bit. The other thing about this chart that I'd note is that there's in very recent history, so I'm just pointing here with the mouse, in very recent history there's two sort of types of situation where this indicator rises. One is in the late stages of the cycle and where the cycle actually continues for some time. And the other one is as the market is going into a crash, crisis, downturn, whatever you want to call it. So, with that respect, the jury's out. I think the next few charts, they will help add a little bit of colour to that, because we're having a little bit of a volatility theme this week. So the second chart is a more traditional measure. So this is the average VIX or volatility index, implied volatility across global equities. And you can see there that we've made what looks to be a fairly clear cyclical bottom in implied volatility, and we're dealing with slightly more limited history here. But you look at the mid-2000s there, and there's actually quite a bit of parallels. And it's quite common to see volatility, implied volatility, rise towards the latter part of the cycle. I mean, it obviously rises at the end of the cycle, and of course that raises the question, where are we in the cycle? We'll actually get onto that in chart number 4, so I won't labour that point. But the point here is that implied volatility, I think that we've seen a cyclical bottom here. Number 3, credit spreads and the VIX. And these two things that trade fairly closely together for obvious reasons. One's basically equity risk pricing, the other one is credit risk pricing. And again here, I believe that we've seen a cyclical bottom in credit spreads. I've been talking about this one for a while actually, and there's a few orange and red flags starting to show up. On the red flags, there's obviously volatility itself, and credit spreads have a tendency to sort of follow along where volatility is going. Another one is the credit managers index. There's a couple of sub-indexes in there that I keep an eye on. Those have started to make a turn. And then there's a few orange lights, like just the fact that they got that low. It's kind of extreme valuation, and a couple of other indicators I'll be going over probably this week actually in the next weekly report. So I'd say odds are that we've seen a cyclical bottom there, and look at global growth. Looks like we're in the middle of a growth scare as well, and one pretty important determinant of credit spreads is the growth impulse. If growth slows or has some sort of wobbles, then that raises the odds of default, and certainly it would implore investors to reprice the risk of default, which is basically what a credit spread is. It's the credit risk premium. So it's I think it's a pretty hard ask to own credit at this point, given the risks here. And given the sort of asymmetric, or the asymmetries and payoff profiles in credit versus equities. So number 4, the yield curve and the outlook for volatility. So again, this is, so I might just read out what I've written here first. It's no secret there that we are late in the economic market cycle. And for clarity, being late in the cycle is not the same thing as being at the end of the cycle. Indeed, volatility can rise along with the market, but either way, we've clearly seen a regime shift. And I mean, that's the bottom line. We've seen a transition from the low volatility environment to basically the more volatile stage of the cycle. And it is very clearly the later part of the cycle, but to me, it's not clear that we're at the end of the cycle. There's definitely some soft spots there, but there's a lot of carcasses at the bottom of the cliff of the those who are calling for a recession too early. So I'll leave it at that on the sort of volatility quad of charts. If you've got any comments or questions about those, put them in the comment section below. But before we wrap up, this is our one last chart, and this one's a slightly different topic, and that is economic policy uncertainty and the Chinese bear market. So as I noted here, I highlighted this one in last week's report, and basically it's a reference to the fact that policy and politics, well, they've been presenting real headwinds to the market, and the Chinese A shares have been in a bear market for the last, well, for all of this year basically, been in a bear market. One thing that has done is made them very cheap, but all seasoned investors, all seasoned value investors will know that being cheap is not enough. Cheap can get cheaper, and you can be holding something that's cheap and sitting there waiting for years before it turns around. So what will be the most likely catalyst to trigger an end to the bear market and some upside risk for China A shares would probably be policy and politics, in my view. One aspect there is that a few of the things that you talk about in policy and politics are two-way risks. The trade war and the the sort of power skirmish or power struggle with America. That's two-way because they could resolve that. They could come to the table and make a deal, and that would definitely change risk appetites, risk sentiment, and definitely certainly outside investors' attitudes towards China, I believe. And then the other one is there's clear economic headwinds. China's basically going into a slowdown at the moment. At a certain point, that becomes the dominant part of the sort of strategic tension that China faces, which is the, on the one hand, deleveraging and reform, and on the other hand, stimulus, maintaining stability. And I think that'll come into play, not quite yet, but probably increasingly so. Some of my contacts there say that they've already turned made a clear shift in terms of the policy bias there. And we have seen some piecemeal measures towards stimulus, but nothing that's as forceful as some of the previous episodes. I've got a couple of indicators composite indicators that I watch that track the overall fiscal and monetary policy settings there, and those have really yet to move decisively. Once they do get moving, then it's going to be game on for China A shares and commodities in general, but we might see a little bit more pain before we get there. And that sort of brings us back to that whole theme of volatility. So I'll leave it there, and again, if you've got any questions or comments, do not hesitate to put them in the comment section of the YouTube video, and be sure to subscribe to the channel so that you don't miss out on any future updates.